Welcome to this webinar, this IPSOS webinar, that today has a bit of more narrow focus perhaps than today we're zooming in on the financial sector, on the financial consumer, and trying to understand a bit about what is going on there. We specifically focus on, as I'm writing here, the risks and changing priorities that are going on right now, based on a few studies that we've done over the past, well, primarily over the past months, and we're the stage. My name is Jesper Christensen. I have a PhD in behavioral economics, and I'm actually coming out of the financial sector. I've been working in one of the major Danish banks for a number of years. I've been the head of quantitative insights there, and have been working a lot with insights collection, data, and various analyses in the financial sector before I went to IPSOS. So that is my background, that is my claim to talking about these things, and I'll try to take you through as best I can what I think are the main topics that are relevant right now. I'll try to give you a sense both of what the data is telling us, but also how that meshes with the understanding that we have from working in the financial sector. So if at any point you have any questions, either write them in the chat. I'll provide ample time towards the end to address any questions that may be there. But if I'm saying something that you really disagree with, or that you think really needs clarification, shout out and we'll address it during the presentation. Good. I see some notifications popping up. Yes, you can request a copy of the deck at the end, of course. Good. Let's get into the thick of it. So this is the agenda for today. I will begin by trying to plot what I call the finance trajectory. And that's just a fancy way of saying, where were we when the crisis hit? Because of course, we can't really circumvent talking the COVID-19 crisis. It's had a lot of impact, and I'm trying to address that today. So let's start out by thinking about where we were, or where the finance industry was at before the crisis came about. What was relevant, what was topical, what was being worked on, and what were some of the priorities. Then we'll switch to, as I write here, coming out of the crisis. We won't focus too much on being in the crisis, because now we are hopefully heading out of it, fingers crossed. But I'd like to focus on some of the things that we are apparently bringing with us, some of the new tensions that have arisen from the crisis, and also some of the things that seem to stick, even though we've been through quite the turmoil. Once we've talked about that, I'll then move into perhaps the meat of some of the things that I want you to take with you from today, which is this perspective on what is happening with risks, specifically how financial consumers perceive risks, perceive their own situation at the moment and for the foreseeable future, and also rewards. So what is actually top of mind for consumers right now? Has it changed in terms of what they want and what they prioritize to get from their financial, from their bank or other financial institutions? And then, as I write here, the ROCSI, the return on customer experience investment, very fancy term, which is only to say that if the risks and rewards of consumers are changing, it might also be the case that the things that the financial industry are investing in creating a better customer experience, in retaining customers and preventing customer churn, that might very likely also be changing. And then finally, we'll end on a bit of a more positive note. I've called it the postcards from the future of finance, which is essentially just an attempt to look a bit more ahead and say, well, what is the data telling us in terms of what consumers expect for the future? And then, as I said, ample time for Q&A towards the end. So let's get into it. First, this trajectory. So a look at where we were before the crisis. And there's a lot on this slide because there was a lot going on. There were multiple winds of change blowing already before COVID-19 came about. There was, this is going to sound very techno, but artificial intelligence was up. We had, in the bank that I was working in, a whole team dedicated to how we can implement artificial intelligence, various text analytics, all sorts of other things. How can we use that as part of an emphasis on general data usage, being better at exploiting and using the data that we actually have available in, say, a bank, to provide better advice, to provide better service, and also to reduce cost to serve when we deal with consumers? That was very topical, and that was something that was at the forefront for a number of banks. And hand in hand with that were a lot of other technical and cyber-related issues, cybersecurity, for instance. The whole rigmarole that came about around GDPR, all the things that suddenly banks and other institutions had to take care of in terms of how do we collect data? What data do we want to collect? How do we store it? How do we keep it safe? But perhaps not more importantly, but at least in the eye of the consumer, something that's more important is how do we assuage all the fears that follow this for the consumer? So there is a lot of studies being done, a lot of talks with consumers about what do we do with your data? How do we ensure that we comply to GDPR? And how do we make sure that what we do is in fact ethical and compliant? On top of that, now I won't go through all of them because then we'll be stuck in this slide forever. But some of the other things that were very topical were these increasing collaborations with outside partners, fintech and big tech. Who can we work with? Who should banks be working with to provide new and novel services to their consumers? What are the new competitors that we have to face? New regulations came in a couple of years ago, the PSD2 regulation, which essentially opened up the industry to outside competitors who could now offer services that were previously only the domain of financial incumbents, banks, for instance. So suddenly you have competition coming in from outside that you have to address in a completely new way. Then there were all sorts of other more broad economic changes going on. One of them being this hyper-personalization, this sense that whatever we do in terms of developing our USPs, our offerings to customers, one expectation that always pops up is the need to be able to personalize whatever we're offering. And at least where I was working in the banking sector, that hit a snag in terms of we were used to just offering a number of products that were more or less tailored to an entire segment. And now we had more and more requests for personalization. How can we do things in a different way? Which essentially also kickstarted this whole sense of how do we use digitalization in the banking industry to be able to provide more personalized and less costly offerings to various types of customers. One of the other things that goes hand in hand with that is this consumers expecting 24/7 service. The fact that you can only call between 8 and 16 is simply not good enough anymore. They want access. They want to be able to work with the bank to access their finances around the clock. So these are some of the things that were going on. So a lot of things that would challenge how banks and other financial incumbents would view their own product portfolio. They were thinking about digitalization, about security, about data. How do we think about our offerings in a new way? And how do we also remain relevant? How do we remain profitable? So again, if you look towards the end, a number of banks were struggling with reorganizations, staff reducements, because there was actually quite a push on their earnings potential with low interest rates and whatnot. So cutting the slide off here, there was a lot going on already before COVID-19. These are just a few more examples of what was going on. So that is also where we'll dig in today, in this nexus that I've tried to illustrate here between financial services and the consumer, and then market research, which is essentially where we work and where I also want to emphasize a few things. So one of the things that we'll emphasize today is this emerging trend of technological advancement. This is not only tied to the financial sector. This is a broader thing that's going on that, for instance, if you look towards the top left corner, that brands that create personalized experiences see revenue increases of 6% to 10%, 2 to 3 times faster than those that don't. So again, this emphasizes this need to be able to customize more, to personalize more. But specifically for banks in the financial industry, you hit a point at which you have to say, well, if we want to do this, typically that means digitalization in some fashion. We have an app that we perhaps develop more. We have a net bank that we can customize to a greater extent. But all of that risks compromising what is at the heart of delivering financial services, which is the relationship with an advisor. So that was the continuous struggle to say, how do we meet all of these new requirements for personalization and digitalization and whatnot, while still remaining true to what we know consumers have to have, which is a personal relationship to someone they trust. Because however we twist and turn this, the financial issues that they deal with are sensitive to a lot of people, and they want someone they can trust to help them. So there's a conundrum there in how you bridge the gap between these new trends, wanting more, wanting to be able to access better, with maintaining the core service. So that is something that we'll also dig into in a bit. Another emerging trend that I want to highlight is this trend of skepticism and also reliance. So skepticism here means that the need for transparency, being concerned about how your information is used, how it's collected by banks and other companies, is on the rise. Basically, it's coming out of partially GDPR, but also a lot of other concerns and a lot of other cases that have been in the media that have shown that this is an issue and this is something we should care about, how, for instance, the bank collects and deals with all of our personal information. Also, there's a push towards what we call authenticity, that we think changes are happening very, very fast, and we perhaps want that to slow down a bit. We want to go local over global. So a lot of people are also experiencing this rollback to essentially how things were. And with all the data, with all the new regulation, with everything happening, that actually plays into how you view your bank as well. So in studies that have been done, we see that people say, well, my advisor, the person I know, becomes the anchor for me in a world where things are happening very quickly. The services that I'm being offered are perhaps difficult to understand. Perhaps they're changing, the portfolios, the investment options, the pension schemes are changing. And so I need that anchor, which is my advisor, to help guide me through. And so it's very interesting to see during the pandemic, some of the research we did just during the last few months, that depending on if you're an optimist or have a more negative outlook, 47% say that they believe their bank has made sufficient initiatives during the COVID-19 pandemic. And sufficient here meaning that they feel that the bank has helped them cope with the crisis, has given them the necessary information and tools to get through whatever situation that particular customer was in. But if you look at the specific banking variation just in Denmark, so among the top 8 banks in Denmark, the 8 largest banks, this figure, the Reliance figure, that varies between 27 and 64%. So there's a lot of variation in terms of how consumers view their own bank in being able to essentially safeguard this authenticity and give them the transparency and the tools that they need to get over something like a crisis like this. Good. Then the final trend I want to hit on before we move forward is this thing about doing good by being good, which is also going to pop up a bit later. Now, for banks specifically, this has been sustainability for quite a while now. Sustainability has come up and has taken more and more space on the banking agenda. One of the easiest places to see it perhaps are in the new investment opportunities, the pension schemes that are turning more green by the hour. Basically, you get more green investment opportunities, but also more broadly, the importance of brand purpose. So we did a few studies for a number of banks to simply look at, well, what is the perception of the brand of this bank? What do you actually connect when you hear the name of this bank or see the logo? And it's very interesting to see how banking brands are very much sort of they have multiple connotations depending on who you talk to. So looking at the Danish market, for instance, most banks currently, or in the past couple of years, if they're big enough, have been associated with a number of public scandals, money laundering, and whatnot. But at the same time, even though that has been associated with the banks, there's also a high level of trust in the larger banks. So they trust that banks do what they say they do. They have no issue of handing over personal information. They don't read the small print on the deals that they make with Nordea or Danske Bank, because they simply trust that if it comes from that bank, then it's fine. And speaking of third-party collaboration, as we did just before, we see that as soon as we move outside for instance, the web page of one of the bigger banks onto a different web page, behavior changes completely, because then you're no longer assured by the logo of the bank. So your trust declines. So it's an interesting thing that also becomes very important now, that the brands of the bigger banks and most banks in Denmark have this dual thing of at the one side being tied to a lot of things that have been in the media that actually undermine trustworthiness, but they still have a lot of brand capital. And one of the challenges going forward is to work with, how do we maintain that brand capital and don't waste it away by future scandals, but also perhaps by not understanding what the consumer is going to require from us in the new realities that are popping up post COVID-19. So that was just a bit of various backgrounds on what had been going on in the financial sector. And here are some of the examples of the questions that we get. So I won't go through them now, but they range from, how can you help us being compliant? How can you unburden us with some of the complex stuff? How can we understand customer experience better? So a lot of areas where this nexus really becomes valuable. But let's move on to what we have actually learned from the crisis. So one of the key things, of course, is that now that we're moving out of the crisis, the economy as a topic is being brought more and more to the forefront, both of the public discourse, but also in the minds of the individual consumers. So actually, if we look at the data from just before the crisis, the economy as a topic, and also a lot of things related to thinking about how the economy is performing, had been pushed kind of to the back of the mind for a lot of people. But now that we see these disruptions, now that people have been brought into situations where suddenly their job is on the line, they are becoming aware that maybe I can't expect to keep my job forever. Maybe something could actually happen, even though I hadn't really considered that. So attention, both in that way, but also more broadly, is being put on, the chance of being laid off, the chance of being sent home without pay. So the data I brought with me here is just to kind of illustrate that. That's from during the crisis, and to illustrate the awareness of all the new schemes that were introduced by government to try and help alleviate the potential economic downturn that would come. So salary compensation, postpone the payment deadlines, compensation if you're an entrepreneur. So a lot of people actually either have heard and know something about these measures, or at least, and only a relative minority have not heard about some of these main measures. So that's to illustrate, well, for one, that people know these measures exist, but also to illustrate that, in fact, this has really entered the public conscious, that the economy is going to be a matter of importance now. And now I want to show you a graphic that I hope is actually working. It's an infographic. I think it is. Let me know if it's not. So this is taken from a study called What Worries the World, and specifically what worries consumers in Denmark. Now, the screenshot that you see before you currently is taken from January 2020. That's where we're at here. And at the very top of the list, we have climate change, then we have immigration, social programs, the welfare state, poverty, social inequality, a lot of very broad topics, financial, political corruption, healthcare, taxes. So all of the big winners, right, were there. And the state of the economy is down here almost at the very bottom, with 4% being concerned about that. So let's see what happens when we scroll forward a bit. Hopefully this works. So not a lot of change here, just a few changes. But then we hit February and something starts to happen that perhaps we're all aware of. Someone new enters the picture, which is the coronavirus. And for a good month or so, it takes up more or less the entirety of our attention until around the middle of March, where the increase in the worrisomeness of the coronavirus tends to stagnate and something else begins to happen. Now I moved a bit too far, so I'll just do this. Whoops. So if you see here, so here the coronavirus here at the beginning of March is at its peak. 57% indicate a worry. And the state of the economy is still here. Now it's in fourth place, but it's still 4%. And it's mainly just in fourth place because all of the other ones are also at very low percentages. But have a look at what happens to the state of the economy as we move forward. As the coronavirus stagnates and we tend to maybe feel that we're getting it under control, it's the state of the economy that begins to worry us. And that's actually the point here. As we move forward, that becomes more and more of a concern for more and more people. Switch the slides and it won't do that. So I'll just do like this. Sorry, just a bit of a snag here. So I can talk about it while, sorry. So that is actually that, well, that's the point, right? That it's becoming more and more problem. You ask about data for May. I don't have it in this one. The data for May is there somewhere. I actually don't know if it's ready yet, but otherwise it will be in not too long. Sorry. So the fact that now suddenly the economy is really entering the equation and most likely is going to continue being that way is an indication also of what I want to talk about now, is that the financial sector, the banks, have suddenly been rocketed to a very, very important position and a position of a lot of attention. So coming out of the crisis, as I just explained, this job security and working situation, most of us has been exposed to this either directly or indirectly. And we actually have 14% that are being sent home with pay, and 6% have either been terminated or sent home without pay in our data from the beginning of April. And what we see in the data also is that we're adapting to this situation because 30% of us actually expect to work more from home in the future and generally expect to begin to adopt these new working habits that we've been introduced to. So not only are we adapting to the immediate shock of changing, but we're also learning more about how we could work, how we could view our work life, and also we're learning more about our finances, our economic situation, which is why it's becoming more and more of a concern. So if we look at the data specifically about financial concerns, not only during the corona crisis, but specifically also looking forward, what we see is that if you look to the top left-hand corner, is that 10% had economic challenge or financial challenges before the corona crisis. 8% say that on top of that, they now have financial challenges due specifically to the corona crisis. But we actually have more people expecting to encounter financial challenges going into the future, either within the next 3 months or in the longer run. And that is something we have to concern ourselves with, because if we dig a bit deeper into the data, we actually see that 66% of respondents report some concern of their job situation either now or in the future, and 15% are acutely worried. So, and if we dig into these data, what we see is that it's not only, will I get laid off specifically this month during or due to corona, it's also, I've now become more aware of the fact that my job situation is not perhaps as strong or as given as perhaps I thought it would be, specifically when we've been in a booming market for a number of years. And now I'm actually becoming aware of the fact that I have to take care of what I have. I have to think about the opportunity that I can get laid off. And that translates to some changes in priorities, some changes in risk perceptions that we're now going to talk about in just a moment. Before we get to that, I just want to specifically dig into a hypothesis that we had, which was, as you see on the left-hand side, this thing about lower income households being hit hardest during the crisis. Because what we know is that they are twice as likely to take on debt if times get tough, as we see in the data I have here. 23% have increased their debt during this crisis of the ones that earn under 50K, compared to 11% for those that earn more. But when we look at the data from our study during the corona crisis and what people are actually saying, if you look at the top left-hand corner, well, a number of people are indeed concerned with basic utilities. Can I pay for water and heat and electricity? Can I pay off my mortgage? And we do see that it's age-related. So if you're in the elder segments, well, you're not that concerned, specifically probably because you're already set in your ways, you have put things away, or perhaps you're actually leaving the job market. But for the other age groups, there's not that much of a difference. You don't see that it's only the 18-year-olds or the 22-year-olds that have troubles. It's actually spread quite neatly across a number of age categories. And perhaps even more strikingly, if you go to the lower left-hand corner, what we illustrate here is the thing we saw just before about financial challenges. So what we're plotting is who is actually reporting a concern about financial challenges, because the hypothesis would be that it's only the ones in low income jobs, right? And indeed, if we look at the first set of columns, where it's already had financial challenges before the crisis, yes, we see that's concentrated mainly with the lower income categories. So the people who earn less, perhaps also the people who are less educated, well, they tend to have more financial challenges. But when we look at the other three sets of columns, so the first one being, having financial challenges due to the corona crisis, and the other two sets being, expecting financial challenges either in the short term or in the longer term, we don't see this income effect, because something like this is not only hitting low income people, it's hitting across the board. And that's a very important takeaway, specifically also for how our risks perceptions change and our concerns are growing. And then, of course, how banks should address that. Because if it's not just hitting the low income groups, that indicates that this is a more broad-based problem and something that we actually need to address in our entire consumer base. Good. One of the things that come out of this is to say, well, now banks have the chance of a lifetime, right? The financial sector has the chance of a lifetime to really work on their image, because it's no secret, and I already mentioned that specifically in Denmark, at least, and in the Nordic countries, the public image of financial institutions is not the best, or it has at least been challenged over a number of years due to some very publicized cases and generally a tendency for banks to get into some situations that are perhaps difficult to explain, at least. So the crisis came and provided an opportunity to show how important a job they're actually doing, what societal functions are being lifted, and how they could now step into the shoes of the companies that would help and alleviate the problems. And so what we saw, however, and it's very interesting now, if you look at the bottom, 47% believe that their bank has made sufficient initiatives during the pandemic. I mentioned this statistic earlier. So you can turn that either way and say, is that good? Is that bad? It's probably somewhere in between. But if you look to the right-hand side of that, only 21% on average believe that their main bank has performed as well as other banks in the market. Now, this is a weird statistic, right? Because this indicates that no matter which bank you look at, only around 20% of their customers think that that specific bank is performing as well as other banks. So this is an interesting thing, because it indicates that a lot of consumers find that maybe I would have been better off elsewhere. Maybe I've heard of better things being done by other banks. And this is exactly the problem that I want to highlight here, is that if you look on the left-hand side, that financial brands rank in the very bottom half of industries that are capable of doing good advertisement, and more broadly are able to actually communicate what they're doing to illustrate what they're doing and why it's important. So there's a huge opportunity here to say, well, we're actually doing a lot of good, but it's getting undermined. So, whoops, some of the primary KPIs that you measure when you're in a bank, such as the Net Promoter Score, customer satisfaction, customer churn, that gets affected by all of this. The fact that even though you're doing great work, out there in the mind of the consumer, you are in constant battle, in constant struggle with some of these things that float around, these cases about what you've done or haven't done, or what other banks perhaps have done better than you. Was it a question or just someone unmuting? Probably just someone unmuting. So there's a massive task here to say, well, how can we as a financial industry actually start working and illustrating what we're doing in a way that doesn't get bogged down in these kinds of statistics or these kinds of effects, because that is actually preventing the industry as a whole from using this crisis as a springboard to say, well, we are actually doing a lot of great work in this area. And we can put a positive spin on things as well, because it's not all doom and gloom. Because if we look at the data, both now this is global data, but we have data as well for Denmark specifically. Actually, some people are saying, well, we're actually holding back for these kinds of investments that tend to require the bank to get in. So home improvements, buying a new car, buying a new home. It's not that we've completely forgotten about it or that we will never do it again. It's just we're holding out for when some improvements come, and then we will need the bank again. So there is some pent-up demand that the bank will experience. We specifically in Denmark have data for car purchases, and it's the same pattern. It's not, if you had plans to buy a car, you've not completely scrapped those plans, you've just put it off a bit until things are looking up again. So it will come back. And that's again a huge opportunity for the financial sector to say, well, now we can show you what we're doing. But if we get bogged down in this bad advertising or these statistics that illustrate that, in fact, we're competing with other banks on grounds that are very unclear, well, then it becomes very important to get these benefits, specifically post-corona. And that's what I'm going to talk about now. I've already alluded to it a bit, how risks and also what consumers are interested in have begun to change as a result of this. But now I'll dig into it a bit more, because that is specifically where, at least the argument here is, that the key is for how to get better at trading what you do and actually winning over customers of the crisis. So one of the things that we see in the data that we've collected, if we start on the left-hand side, is that there is indeed a shift in how people view their own risk preferences. So if you look here, 36% say that they will now pay more for travel and cancellation insurance. 30% will try to save more compared to before the corona crisis. 23% will invest less in risky assets, so various forms of equities, for instance. 16% generally will reconsider their insurances and probably get more. And 9% only will consider switching their main bank. So these are some of the statistics coming out of April specifically. And if we dig a bit deeper, if we do some more work on what this actually means, well, as I've written out here, this stems from the fact that a lot of consumers, both business consumers and personal private consumers, are experiencing these urgent needs. Some of them actually need financing. Some of them need understanding, because perhaps they can't pay a bill, perhaps they need a mortgage to be set off for a bit. But some of them also simply need some assistance in trying to understand their own situation, in becoming aware that they are in fact financially secure, or having at least a partner that will help illustrate how they are secure and what they can expect. which is why the role of financial institutions, as I've mentioned a couple of times already, might actually now be more important than ever, because now you have consumers who are put in a situation where the risks have become much more tangible, as these data illustrate. And also, they've been forced into some of the patterns that we were trying to force them into before. So the main one, if you look at the fourth piece of text I have here, where I've written effective digital delivery of services, that has now become the norm. Before the crisis, most banks were trying to push consumers towards more digitalization. Please do your banking in our app or in our net bank, and please don't have as many physical meetings because they're actually quite expensive to conduct. Of course, you wouldn't say that, but that was at least some of the things that were on the table, trying to develop better digital solutions, more accessible 24/7, to try and move consumers to those platforms for a number of reasons. Now, during if they weren't before. So there's been this shift, and some of those customers are actually, being exposed to some of the things that perhaps they hadn't been before, that will help move this forward. But what is also happening is that customers are becoming increasingly risk averse. So that is illustrated by some of the statistics I have here, but also more generally that they are holding off on decisions, and the relationship with the bank is now becoming more important. We see that in some of the other data we have. So the rewards, or more specifically what the consumer is now looking for, is shifting from some of the things that were relevant before. That would be, competitive prices, good interest rates, good digital solutions, those kinds of drivers that were typically part of whichever customer experience survey you would do for a bank, to now be more focused on, help me feel secure. Help me realize that you are my partner as a bank, and that you can help me get through this situation, and that you can also help me plan for how to be safe and secure should such a situation arise in the future. So that is actually also what this quote towards the bottom of the slide illustrates, that these short-term reactions that we see during the crisis are not only short-term reactions. They are, in fact, also beginning to translate into long-term consumer intentions. For instance, as I just said, in wanting the bank to help make sure that your financial situation is not only secure just for now, but it's actually safeguarded for the future, because now you've had a very tangible example of how things can very quickly crumble and become very frail and difficult. That also means, for the second point, that the relationship with the bank, that is still very much something that consumers are seeking. But if we look at data from satisfaction surveys and customer experience surveys from before the crisis, well, the relationship with your advisor was almost always the main driver of whether you stay with a bank, whether you're happy with the bank, whether you're willing to recommend it to others. But what is happening now is that as you can't have a physical relationship as well, it's changing how you view that relationship. I'll get into that in a bit, but the relationship is still very, very much sort of the epitome of what is important in the financial industry. So specifically, this ROCSI, the return on customer experience investment, it changes due to this, because before, at least in what we've seen, the customer experience treatments that were given was in trying to measure, how do we perform? Do we have a good net bank? Do we have a good app? Are people using it? Do people like our advisors? Do they like the opening hours of our branches? So a whole host of things that we measured on to try and understand, would consumers recommend us to others, for instance, the classic NPS metric of consumer experience. And what is happening now is that it's becoming a different animal. It's, do you feel secure with the bank? Do you feel that the bank is giving you the information that is necessary to feel secure? And in the data we have from the crisis, that statistic is very, very varied among the banks in Denmark, which is an indication that there's a lot of difference in the way that banks went about this. Some banks have upwards of 60% of consumers saying, well, we think the bank actually gave us good information, timely information, and was available when we needed it. And for one other bank, well, we're below 10%. So now I won't be throwing names up during the presentation, but it indicates that there's a lot of difference in how banks are dealing specifically with this type of metric. And if that becomes the main experience drivers going forward, instead of perhaps some of these other things I've mentioned, well, then it seems that banks have a lot to learn from not least each other, but also from other areas in terms of how can we improve. And it's very illustrative because just recently, I think it's just a few days ago, a massive survey was released in Denmark on the general satisfaction among banking customers. And we've already seen reactions from banks saying, well, we don't basically believe the numbers because it just doesn't fit the way we see our customers. It doesn't fit what we hear and what we learn when we interact with them. So that might also be the indication that, well, actually now maybe the focus for a lot of consumers is changing post-corona, and we need to understand how and why, and we need to get better at identifying those new or at least changing sets of drivers that will help, give us these things that we're interested in: higher retention, stronger advocacy, operational efficiency, these things. Good. I already mentioned the things on this slide, so I won't do it. So just as a final note, let's look at the postcards from the future of finance, just as a very tail end of the discussion. So what we've discussed, or what I've said, can basically be summarized to 2 slides, right? One is that due to all that has happened, some arenas, some of the battlefields are going to change fundamentally, and they are in fact already doing so, either because we're accelerating trends that were already in the market, or because completely new things have entered the picture. So I've taken the liberty of bringing this one in from Danske Bank, which I think is not different from what is going on in a lot of other places. This palace revolution, that they're going to initiate a massive change in organization, both in how they organize, but also in the way that employees work, in the way that they ensure transparency, and a lot of other things that will follow through here, because they recognize, perhaps, I don't know what's going on in their minds, but it seems to be that they recognize some of the things that we've also been mentioning here, that there's actually a need in the future. How will employees work? How will your branch employees interact with customers? What are the main customer touch points now if it's not in the branches? How will you communicate? And how will you ensure that you innovate correctly in that environment? Also for customers, that's maybe what we've spoken most about today, is that essentially in some aspects the world has changed for customers, and they will demand more security, but they may be willing to compromise on other areas. The one example I pulled up earlier was the whole digitalization thing, that whereas before maybe some segments were difficult to convince in terms of, use the digital platforms, now they've been forced to, and now also maybe if they can get security and get a form of relationship, well, they're willing to do that. Point, the digitalization and third parties, which is going to accelerate. Collaboration with fintechs is going to accelerate if banks are willing to, or they want to, address the need for more personalization, more customization. Also, perhaps most new on this list is the branding thing, which we saw with the points about advertising and only 20% generally thinking that their bank did better than other banks. So there's definitely a role for banks to say, how do we get on the offensive here? How do we get out and actually illustrate what we're doing? And how do we combat some of the things that apparently are living well in the market as stories and as indications of what we are as a company that maybe we disagree with? And finally, advice. As I mentioned, the studies that we have demonstrate that the advisory is the single most important driver. So how do we do it now if there will continue to be restrictions on how we can interact, if perhaps people are becoming less willing to interact physically. We have data illustrating that, for instance, public transport is going to go down with around 27% because people simply want to avoid that going forward. So this has indeed impacted how we view interactions in the public sphere. So maybe now it's more than ever necessary to have alternatives to the physical meeting with a customer, but we still need to maintain the feeling of personal advice. So some arenas will remain more or less the same. So we still have to track the ROCSI, we still have to measure customer experience and try to make customers satisfied. We have to give them what they want. And we know, as I mentioned here, banks with close customer relationships are, simply a better business model. We have to keep advisory going. Digitalization, while it isn't accelerating, it's still what we have to do as banks to reduce cost to serve. We still have to work with our transparency. That has been very topical, in the past. Branding may be becoming more critical, but there's still a lot of work to do in transparency. For instance, in the data area that I mentioned earlier. So how do we illustrate what we do with data? How do we illustrate that we have clear and transparent processes so that we can avoid maybe something like a money laundering scandal again, or at least illustrate that we're doing what we can to avoid it. And then finally, sustainability, that's also going to remain. That has been topical now for years in the financial sector and elsewhere. And we are seeing the effects in new products being launched, not just by banks, but by insurance companies, by pensions. They have new sustainable green products that they're launching. And one of the challenges there is, well, can a sustainable and green fund be just as good as one that's not? The data that I've seen indicates that it actually can, but it also indicates that people have a hard time believing that. So it's not enough to just offer new and better products if somehow the believability is very low. So this ties back to the whole branding thing, to say, well, if we offer something new, why is it that this is relevant? Why is it that this should support your customer experience? Good. And the final slide of it all before we go to some questions, which is just to sum up that all of this, of course, revolves around the consumer. All of what we've talked about more or less has the consumer at the heart of it. And what we need to do is to acknowledge these new realities that consumers are in fact experiencing, at least areas, new concerns, new doubts, new dynamics, and new things that they are able to feel that they have control over, for instance, their economic reality. And so they will be looking for the bank to become more of a partner, even though it may be in a more digitalized fashion, which may be a good thing for banks and for insurance companies and others if they understand how to use that correctly. And then finally, the customer experience, will be a way to adapt the way we look at customer experience and maybe rethink what we're measuring on, what the success criteria should be for retaining customers and getting happy and in turn profitable relationships with customers. So that was more or less a tour through some of the data we have, some of the insights we've gotten from the studies that we've done, and an attempt to link that to the realities of the financial sector. So let's go to Q&A. I think we still have around 10 minutes left on the call, so feel free to shoot if you have any questions or you want to discuss some of the points that I brought up.